I haven't got anything particularly original to say about the risks in terms of growth next year. I mean, clearly we see a strong bifurcation between reasonable growth in the emerging market economies next year. We'd estimate around 5.5%, perhaps a shade lower now, given the fact that Chinese property is coming off the boil a bit more quickly than we thought. I think where the risk is clearly more evident, I think, is in the developed markets, where we see a combination really of fiscal retrenchment and consumer balance sheet deleveraging, and also bank balance sheet deleveraging, really causing reasonable downside risks. So really, we're only really penciling in something in the region of 1.25% growth in the developed world for next year, giving us a total of around 3.5% across the globe. I mean, clearly, as the Eurozone risks escalate or increase with no final sort of solution, if you like, to the difficulties, we would have to say that the risks on the developed market outlook are somewhat on the downside. In terms of our Eurozone scenario analysis, I mean, one of the things that we've really concluded is that in the Eurozone at the moment, there is a huge risk of what I would call endogenous credit destruction. That's to say that banks are having to delever because they can't raise capital. The only way they can get their capital ratios up is by shrinking their balance sheet. I think the estimates that I've seen are something in the region of 3 trillion euros over the coming years. Now, that's 10% of the asset base of European banks and something like 25% of Eurozone GDP. Now, we're already seeing monetary aggregates show a little bit of slowing. We've already seen a worrying tightening in the ECB lending survey. And what I think actually will ultimately happen is that the European Central Bank, as the institution responsible for ensuring medium-term price stability, will have to do some form of QE. Because what we see is endogenous credit destruction, which has a deflationary pull. The only way to offset that endogenous credit destruction is by some exogenous credit creation, which offsets that deflationary pull. And as we all know, deflation is a far worse scenario than inflation. Because when you're in a deflationary trap, as we've had in Japan, getting out of that with policy near zero has been nigh on impossible. So the conclusion that we come to is that given the fact that the medium-term risks to price stability are on the downside, the ECB will ultimately be forced into some form of QE. Now, taking a step back at the moment, does the refi rate actually play any part in this? Well, in my eyes, it doesn't, because the refi rate at the moment is at 1.25. It could go down to 0. 2-year yields in the Eurozone, the weighted average rate at the moment is around 6%. So the monetary and credit transmission mechanism from the ECB is broken. If you take Greece out of the scenario, it's 4.5%. So we are seeing de facto credit tightening, not just because banks are delevering, but the transmission mechanism of ECB monetary policy into market rates is completely broken. It's quite likely that we'll see 2, maybe 3-year LTRO operations, which are there to ensure banks get access to medium-term liquidity. But we think the only way the ECB can deliver its mandate, which is financial market and price stability, as a satisfactory platform in order to ensure that we can have medium-term growth and reasonable employment, is by expanding its balance sheet. Now, what we do is we attach very simply a 65% probability to the likelihood that in the relatively foreseeable future, the ECB will do what the US Fed did between 1942 and 1951. Now, what the Fed did was it committed to use unlimited resources to defend the 2.5% note on the 2.5% level on the 10-year note. Now, just by making that commitment, what it effectively did was took away all the speculation against the 10-year note, and it ended up owning about 7% of marketable US Treasury debt. in the similar fashion, the ECB could pledge to use unlimited resources to support those countries which are solvent, like Italy and Spain, but are having liquidity difficulties in terms of accessing the market. And that would almost certainly cause a one-off adjustment in terms of spread level. And of course they could use their balance sheet as well to purchase securities as appropriate in order to boost money in circulation. So we think that is quite likely to happen, and it's our central forecast, which I guess makes us relatively optimistic against the consensus. Now clearly the risk scenario, in fact there are two, is that all this requires some form of treaty change, and the result is that the market continues to price in a more negative scenario, and we get what George Soros called this reflexivity between the outcome and financial market participants, because reflexivity is simply the case that when financial markets behave in a certain way, that has an outcome on an effect on the actual delivered outcome. So what financial markets do is affect the real economy. And what the real economy does is therefore affect financial market perceptions and actions. So in a sense, by pushing 10-year BTP rates up to 7.5%, 8%, maybe even 9%, that will have a direct impact on the real economy in terms of the perception of fiscal stability, and that will then feed back into people's willingness, if you like, to own the debt. So that's the risk in the short term, is that we don't see a line being drawn under this particular crisis. It drags on, and in the meantime, the bond market vigilantes who would like to make money out of shorting Italian bonds can continue to do so with impunity. Ultimately, though, if these treaties, if they're required, are changed, we would view this as being reasonably optimistic ultimately, but we would certainly see quite a deep recession in the first half of 2012 in the Eurozone. Now the biggest risk, and this really is the bad scenario, is that for whatever reason the European Central Bank interprets its mandate very narrowly and actually refuses point blank to do what it would call de facto monetization. Now in this scenario it's quite likely that there would be pressure brought to bear on a number of countries within the Eurozone, and people would begin to handicap the potential breakup. But just in terms of highlighting how difficult it is if you do leave the Eurozone, people have been almost talking about Greece leaving and it being fairly straightforward, and they can devalue and they can make money by exporting at a weaker currency. Well, if Greece does leave the Euro, it loses access to the Eurozone payment system, Target 2. So its banks can't even make any payments. So, the idea that somehow it would be a good thing ultimately for Greece is very questionable. And we'd also highlight the fact that Greece as a natural domestic consumer, if you like, of its own produce, or necessarily importer, would probably lose out quite badly from the currency depreciation that would follow, since there wouldn't be any benefit in terms of the terms of trade. So, we probably think things get worse before they get better in the Eurozone, but we nonetheless think that if the Bundesbank was in charge and they really were focusing on medium-term price stability, and they saw the risk of a deflationary credit crunch in Eurozone which couldn't be met by fiscal policy because governments' hands are tied, they'd almost certainly have to print money in some shape or form to ensure that we didn't get corrosive disinflation and a repeat of what happened in Japan from 95 onwards. So what does that mean in terms of our view in bond markets? Well, starting off with the boring stuff, we don't like US Treasuries. We don't like UK gilts, which is probably quite unpatriotic of me, and we don't like German bunds. And it's all quite simple. First of all, we believe that valuations are extreme. Real rates are very, 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 very strongly negative. Secondly, echoing Robert, the flight to quality that we've seen into these assets, I think has reached an extreme level now, and it's quite likely that markets will begin to experience some kind of risk aversion fatigue. But the other thing is this whole idea of a fork in the road, if you like, a bifurcation in terms of possible outcomes. If we have an outcome that turns out to be more favourable, and the ECB does what actually is consistent with its mandate and intervenes in the bond market in much the way that the Fed did during the war and afterwards, the flight to quality for these so-called core sovereign bonds will dissipate. However, if things get a lot worse, and people genuinely do start to worry about the sustainability of public finances right across the board, it's quite likely that bunds, gilts and treasuries will be infected by that same concern and will also tend to rise. Remember, in the UK, we don't run a primary surplus like Italy does. We also have a problem at the moment where we could be falling into an austerity trap. I have a soundbite. I mean, this probably reflects my politics, but I've always said there's no prosperity in austerity, which is, a glib soundbite. But nonetheless, if you're on a liquidity trap and you've got near zero interest rates, being forced in the short term by markets to retrench fiscally will, unless the lower interest rate can stimulate household consumption or the housing market or some form of investment, could actually cause the outcome to be worse. And we're now seeing that already in the UK, where borrowing is going to be higher. And I think the risk of something analogous to what we've seen in the Eurozone hitting the UK is a bit higher. And of course, where does that leave Germany? Well, an optimal currency unit would always include a number of things. It would include, free mobility of labour, free mobility of capital, diversified economy, and the most important thing, clearly, fiscal transfer. Now, in the absence of fiscal transfer, what we had was supposed governance, but the governance wasn't in place to ensure that, countries could actually, over the medium term, meet the Stability and Growth Pact. So, in some shape or form, if Germany wants the Eurozone to continue, and to continue to get the benefits of trading with partners at fairly attractive currency rates implied by the level of the euro, there will almost certainly have to be some kind of fiscal transfer, whether they want to or not. I think ultimately that's going to happen. It may be via e-bonds, it may be via the ECB financing the EFSF in terms of getting involved in the sovereign market there, or maybe by straightforward de facto fiscal transfer, because at the moment what we have is not sustainable. So, core sovereign bonds, which have been if you like, a refuge and a place where people hide, I think are becoming much less safe now, either because we get the relatively favourable outcome or we get the particularly bad outcome. In terms of other places that we quite like, we've taken the view that the emerging markets, bond markets, are offering quite a lot of value here as well. We think prospective growth and inflation differentials are looking relatively favourable. The migration that we see in terms of ratings is certainly extremely good. 90% now of local currency EM bonds are investment grade, and something like 60% of hard currency are investment grade. Just for your information, I looked at it this morning. Apparently, the average budget deficit running the emerging economies is 2%, and the average debt to GDP ratio is around 34%. These markets are certainly volatile in the short term, but provide fairly solid returns over time, both in a nominal and also in a real context as well. The real returns on a whole range of emerging market bond markets are incredibly good. We also buy into the idea of this secular appreciation of emerging market currencies. Why? Well, Western policy setting is clearly towards zero interest rates, so there's more favourable interest rates which encourage positive flows. We would also highlight the fact that even a moderate appreciation of the Chinese currency would give us 3 to 5% per year over the next 4 to 5 years, which would almost certainly push Asian currencies up somewhat with it. And also we note that a number of emerging economies in Asia in particular do use currency management, allowing currencies to strengthen as a way of suppressing inflation. So as a group, and again notwithstanding short-term correlations and volatilities, we would view the secular trend of emerging market currencies appreciating as being a particularly valid one. Where it gets a bit painful, I think, has to be in terms of credit and high yield. Again, we are medium-term optimistic on high yields, euro high yield. If you factor in something like a very modest 20% recovery rate, the cumulative 5-year default priced in to European high yield is something in the region of 50%, which way exceeds, what we've ever seen. And if you provide a sort of similar analysis to, the global credit markets, again, we have something way, way, way beyond even the worst default phase that we saw in the 1970s. Now, clearly a lot of this view in the short term will be governed by the perception of Eurozone sovereign deficit, the ability of policy response to ensure that things don't fall apart. But on that basis, and given our central scenario of the ECB correctly interpreting its inflation mandate, we'd be fairly optimistic that, that both these asset classes actually over time can perform quite strongly. There is another thing I'd like to mention, and of course, I've always been quite a big fan of inflation bonds. Conceptually, I've always liked them. And many years ago, when I worked at the Bank of England, I used to design and issue them. And, I always took the view that, an equity gives you a real return which is not known. So equity earnings and dividends go up in line with inflation over the cycle. A nominal bond gives you a nominal return which is known but not real. And I take the view, well, an index-linked bond actually gives you a real return which is also known if you actually apply an inflation assumption. So therefore, in a sense, inflation bonds are a pretty good asset to hold here, even if you are worried about corrosive disinflation, because they give you sort of elements of both equity and nominal bonds. I noted before I flew out yesterday that out to 10 years, the break-even inflation rate between BTPs and inflation-linked bonds in BTPs as well was negative. So for some reason, the Italian government bond market believes over the next 10 years we're going to see falling prices, which again I don't think makes a lot of sense. I think debt deflation is a risk, but certainly over the next 2 or 3 years you could see the inflation moderating, but certainly not the actual price level falling. So I would actually say, and we are already quite big fans of BTP EI, simply because they trade incredibly cheap on a real rate basis to an already cheap nominal bond market that over medium term we think will probably perform okay. This brings me on to something else, because clearly investors like the idea of real assets, physical assets. I had a conversation with a strategist at UBS, and he said a lot of his clients had bought gold. And they got gold in vaults in Switzerland, but what they did is, because they wanted to see it, they had cameras on the gold that they could actually see from their screens at work to make sure it was still there, which I find amazing, but people do that. But in the context of what Aberdeen does, one of the things that is quite exciting to the property team and the team in Milan in particular is this idea that we're on the cusp of launching quite a substantial fund which will be investing in 3 large retail outlets which are diversified across Italy with a very large take-up rate of something like 98%, that will give roughly 5.5% or so index linked to inflation, and it's been stressed to an 85% let, which will still give a 5.5% return. So there are some really quite exciting prospects out there, and given the fact that the valuation of these so-called outlets will be extremely reasonable and will not reflect any latent overvaluation that might have taken place in previous years, there could be some modest scope for capital appreciation as well. So that kind of asset, I think, sits quite nicely in the context of a diversified portfolio. I think I've probably covered everything, other than the fact that we remain quite big fans of emerging market equity, really for similar reasons to the ones I've already suggested. But yeah, I think I'll leave it there, actually. I think I've covered enough.
Okay.
Thank you.
Thanks, John. Grazie, John Cunliffe.